Is Canada's dream of housing affordability slipping further out of reach? A recent report from the Canada Mortgage and Housing Corporation has brought the harsh reality of the housing market into sharp focus, revealing that even a doubling of home building activity would only restore affordability to pre-pandemic levels. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. The new assessment from the Canada Mortgage and Housing Corporation revises earlier, more optimistic projections and underscores the escalating scale of the nation's housing affordability crisis. While major urban centers like Toronto and Vancouver have long grappled with a lack of affordable housing, the period of low interest rates in 2020 and 2021 significantly fueled a home buying surge. This, coupled with rapid population growth following the easing of pandemic restrictions, led to a frenzied market where prices escalated dramatically across numerous cities and regions. As of last year, the costs associated with a typical mortgage consumed approximately 54% of the average Canadian household's income. To address this widespread issue, the Canada Mortgage and Housing Corporation's latest report suggests a significant increase in construction is necessary. The country must boost annual home building to as many as 480,000 units by 2035 to bring affordability back to its 2019 levels. This is a substantial increase from the current rate of approximately 250,000 units per year. Earlier estimates from the National Housing Agency had called for a similar construction boost, aiming for achievement by 2030, with a more ambitious goal of restoring affordability to 2004 levels. However, the Canada Mortgage and Housing Corporation has now stated that restoring affordability to levels last seen 2 decades ago isn't realistic, especially after the post-pandemic price surge, emphasizing how pervasive the housing affordability challenge has become. The revision in the Canada Mortgage and Housing Corporation's forecast and timeline is partly attributed to the lengthy processes involved in new housing construction. The updated estimates now factor in rezoning procedures, which can add years to development schedules. These projections, while not official government targets, provide a clearer scale of the problem. Despite these adjusted expectations, Prime Minister Mark Carney, who was elected in April on promises to tackle the housing crisis, has maintained an election platform pledge to ramp up home building over the next decade, with an eventual goal of reaching 500,000 homes per year. Economists surveyed by Bloomberg anticipate that Canada's housing starts will average a lower 230,000 units between 2025 and 2027. This projected deceleration in construction is primarily due to the ongoing impact of higher interest rates and general economic uncertainty weighing on the industry. The Canada Mortgage and Housing Corporation report illustrates the potential impact of increased construction. Doubling the current rate of home construction could see the affordability ratio drop to 41% by 2035, a notable improvement from the current 54%, though still a significant portion of household income. Without this increased pace, the report warns, the current construction rate would yield almost no improvement in this ratio over the next decade. Among Canada's major cities, Montreal, the second largest, faces the most significant housing supply gap, with affordability projected to worsen if current trends persist. Toronto, the nation's largest city, would require a 70% increase in annual home building to see improvements in affordability. The report notes that while housing prices and rents in Vancouver and Toronto have long garnered international attention, these increases now burden many Canadians, with low-income and even some middle-class households struggling to find suitable and affordable housing. In the realm of commercial real estate, investors are finding themselves in a favorable position to capitalize on the current economic climate, according to Brennan Yedlowski, Principal and Managing Director at Avison Young Canada. He points out that with interest rates easing, there is a unique window of opportunity for investors to take advantage of favorable financing conditions. It is always a good time to invest in real estate when financing or debt is cost-effective relative to capitalization rates. And now, We are currently getting close to pre-pandemic interest rates, Yadlowski stated. Yadlowski highlights that the current environment of compressed fixed and variable interest rates is a key driver behind renewed acquisition and refinancing activities. Fixed-rate commercial loans, typically priced over the Government of Canada bond yields, have seen a decline compared to the previous years of 2023 and early 2024. Variable rates, linked to the prime rate, have also decreased significantly due to 7 prior rate cuts from the Bank of Canada, bringing the prime rate to 4.95%. Low interest rates are a strong indicator for commercial real estate investment activity, as financing and resulting cost of capital for investors are more favorable, Yadlowski explained. Despite the recent economic volatility and ongoing tariff concerns, Yadlowski believes that now is an opportune time for refinancing or new acquisitions, especially as rates trend closer to pre-pandemic levels. The Canada Mortgage and Housing Corporation insured loans continue to drive multifamily development, but there is growing interest in conventional loans due to tightened CMHC lending parameters introduced in the fall of 2024. CMHC-backed construction loans offer up to 95% loan-to-cost, but the agency currently withholds 10 to 15% of leverage until projects are complete and stabilized. This has led many developers to consider banks, credit unions, and private lenders offering 75% loan-to-cost without the CMHC's lengthy approval process. Yadlowski notes that lenders remain active, though they have become more selective in their underwriting standards. They are asking more detailed questions, particularly concerning tariff exposure. There is still ample capital available for retail, industrial, and multifamily properties, with increased interest in retail and select office assets as lenders seek to diversify their portfolios. Expect lenders to be asking more questions to better understand each borrower's exposure to tariffs, he said. Looking ahead, many lenders anticipate 2 or 3 more Bank of Canada rate cuts in 2025, with a potential for a 50 basis point reduction over the next 6 months. This would push the prime rate below 4.50%, making construction and variable rate acquisition loans more cost-effective. Yadlowski expects a strong lender appetite for commercial real estate debt to continue throughout 2025, especially for acquisitions, refinances, and developments in the retail, industrial, and multifamily sectors. My outlook is that this will continue in the second half of 2025, and investors or real estate owners should have availability of debt capital for their commercial properties, he said. In this evolving landscape, Yadlowski emphasizes the crucial role of commercial mortgage brokers. Mortgage brokers can make a huge difference in this type of environment, he said. These professionals possess a deep understanding of lenders' credit underwriting parameters, interest rate pricing, and lenders' appetites. Brokers not only identify the best lender-borrower match, but also help underwrite properties accurately, including conducting sensitivity analyses on interest rates, capitalization rates, and lease terms. Investors may believe they have the lowest possible interest rate available with their current lender, but when you can create a competitive situation, it's always beneficial, Yadlowski noted. Cameron Stevens has recently launched the Western Canada High Yield Mortgage Fund with an initial equity commitment of $70 million. This fund is set to invest in a strong pipeline of commercial real estate deals across Western Canada, focusing initially on Alberta and British Columbia. This initiative comes as part of Cameron Stevens' broader expansion strategy in the region, where they have grown to over $550 million in assets under administration over the past 4 years. Steve Cameron, President and Chief Operating Officer, stated, "This new vehicle allows us to deliver capital faster and with more flexibility in Western Canada, while drawing on deep local insight from our newly formed Western Canada Investment Committee." The fund is structured similarly to the Ontario-based Bay Street High Yield Fund, which has delivered an impressive net annualized return of 11.4% since its inception in 2004. Investors in the Western Canada Fund will gain access to a diverse array of mortgage investment opportunities designed to offer diversification across location, mortgage type, and asset class. According to Phil Housley, Cameron Stevens' chief of staff, The fund is particularly focused on income-producing properties and land with near-term development potential in Alberta and British Columbia. In today's environment, we're seeing strong borrower demand for flexible, non-bank financing on light industrial, multifamily rental, and well-located retail properties, Housley shared. The firm has already identified 5 deals in progress and will participate in syndicated first mortgages originated by Cameron Stevens Mortgage Capital. They plan to take a 10 to 15% subordinated position in deals ranging from $10 million to $50 million, enabling them to fund approximately $600 to $700 million of originated loans in Western Canada. Brad Wise, Senior Vice President and Managing Director for Western Canada, expressed pride in bringing together highly respected and experienced Western Canadian real estate families to support this strategy, noting their invaluable regional knowledge. Cameron Stevens aims to scale this fund with additional equity infusions, much like their Bay Street High Yield Fund, which began with $25 million and has since grown to over $350 million. Housley highlighted strong long-term fundamentals in markets like Calgary, Edmonton, Vancouver, and the Fraser Valley, emphasizing the critical role of private credit in supporting real estate development and refinancing needs. Our ambition is to originate $1 billion in commercial mortgage loans across the region within the next 2 to 3 years, Housley stated. This fund provides Cameron Stevens with the capital structure to scale and deepen client relationships, playing a meaningful role in the region's growth. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.